So today we're going to look at Zoom stock and if it's a buy after the crash that it's been on. It's currently down 80% from its all-time highs, and after earnings yesterday it's currently down 11% after hours, and I thought I'd give my thoughts on this one and if it's currently a buying opportunity on this dip. Now, I've never talked about Zoom stock on the channel, I've never given it its own dedicated video, and I know a lot of you guys really do like these in-depth videos into these stocks. I do quite enjoy doing them, but the problem is normally the views are terrible on them. And the thing is these videos actually take the longest to do because I have to get all this information about a stock that I probably have limited knowledge on. So hopefully it does well, but we'll get stuck into Zoom and if it's currently a buy on this dip. So I'm sure most of you guys will know what Zoom is. Basically, it's a video conferencing software that you can use for probably businesses, or you could do it with just generally meeting with friends or family, but it was more orientated around businesses. And especially when we were in 2020, this rose to massive fame because of the pandemic and people needing to still communicate through work, or maybe that is through education. The main software that a lot of people went to was Zoom, and that benefited the business massively in that time frame when it was needed. And as you can see here, it's currently down now 10% in pre-market, down to $86 from $97. It does trade at 23 times earnings, but we will be talking about this in a little bit because actually this is going to be incorrect very quickly. It's a 29 billion market cap, and if we look at here the rise that it had through 2020, it was a very big rise, as you can see here, from around about $66 all the way up to $511. That is correct. And since that time frame, we're back down to $97, or within a few hours it's actually going to be $86 probably by the time you guys see this. Now, Zoom itself makes money from plans and pricing, so a bit of a kind of SaaS model. It has its basic platform that a lot of people use, which gives you up to 40-minute time limit. And they have actually started to, one of the things that Zoom have brought in is to monetize that through advertising as well. So they stick adverts on the free side of the platform. So that's obviously a part of the platform now that a lot of people use, and they're actually monetizing that quite well. So that's brought a bit of money in for them. They've also brought in a pro platform, which is, as you can see, is in pounds for me, because obviously I'm from the UK, £119. And with that, you can have no time limit on it, which a lot of businesses will use because obviously they don't want to be restricted with time limits. And then a business one, which will also increase the maximum people that can attend that meeting, as well as a few extra features as well. And I believe there's another model that you have to inquire from, which I think is the enterprise model. Now, they have been bringing out some new features to try and help maximize the potential for them to make money. One of them, like I said, is maximizing that free platform that a lot of people use through advertising. They've also launched a few extra things like what you can see here, which is Zoom One. They've also introduced the all-new Zoom Whiteboard, a new extra feature, Zoom IQ as well, and Zoom Contact Center here, which they're hoping to help bring more engagement and more money in for the platform, which is some of the new features that they've launched at the moment. So that's how the business basically makes money through them services right here. Now, one of the big issues that Zoom has had is that it's kind of a victim of its own success right now. As you can see here, when it was really needed during the pandemic, it had the massive run on the share price. Also, when you look at the reflection on the revenue part of the business, you'll be able to see here that the business was slowly up trending in 2019 in a good direction with revenue growth into profit. And when we really hit that 2020 period, you can see there was just an absolute explosion in the profit and the revenue, which sent the share price absolutely bonkers. The problem is that eventually people realized this revenue growth rate and profit growth rate wasn't going to be sustainable. When people realized that people are actually not going to use the platform as much, people are going to go back to the offices for say business meetings, and Zoom was not going to keep up them growth rates, and in fact was going to have quite a bit of a slowdown. And then that was reflected in the share price with a bit of a drop off, as you can see here. But the problem is that what I'd say at the moment is that what is really interesting is Zoom is actually still holding on to a lot of the attention they captured during that CV time. The business itself isn't growing anywhere near the same rate, but it's not losing revenue, and in fact businesses are still contributing more, as you can see here, which was 37% year over year in the last earnings. So actually, even though the business has had an absolute tumbling on the share price, it is still holding on to a lot of the growth that it did capture through the CV19 benefit, which I think is very key to point out, because when you look at that, you'd think that it's basically a platform that's peaked, but actually, given that the surge that it's had, the tough comps that it's had, it's actually holding on to quite a bit of retention, which I think is really important. So that's quite impressive. Obviously the growth rates are nothing like what it was previously, but I think that's worth shouting out. Now people will point out to the competition with this platform. I have to say that the thing is that you can make it, this is one of those stocks that you can go, yeah, oh, it's just a video conferencing platform, it's easy to copy, it has no moat. And people will say that. However, I would disagree with the moat side of it, because it's like Google search. You would say Google search is the moat because everyone knows Google is the go-to platform to search, and it would be very hard to break Google down now because everyone's used to it. You can make it sound a very simple moat that Google just has a search engine, but it's more than that. And I think Zoom's exactly the same. Zoom has now been, the benefit from the CV situation has mean that it's come a household name. Everyone knows what Zoom is. Everyone's got Zoom on their iPhone or their computer and knows how to use the platform. And I think that as long as Zoom keep up with that and have a decent platform that's very easy to use, don't do anything stupid business decision wise, I think that because Zoom has come so mainstream now, even if we have a society that opens up, people are still going to think, you know what, rather than traveling that half an hour for that video, for that meeting I have, why don't we just do it on video? I think that there's still going to be a fair amount of demand there for the video conferencing platforms, especially like Zoom. And sure, I don't think it'll ever be kind of, back to the growth that it had in the pandemic levels. But however, when I look at the video inside of it, I still think there's a very good future for it. And it also has a benefit that it got from the CV situation, a household name that it wouldn't have had without that CV situation, which will, I think, benefit still in the long term. Now, when you do look at the financials here, it's a bit of a mixed bag. You can see here that the revenue is still going to move very much in the right direction, which is key. I think as long as this business puts in 10% plus revenue growth, that is actually a really good amount of growth here, especially when we start moving out of these tough comparisons here. One of the key things that I noticed though is that analysts are forecasting a massive drop down in the profit, which is a little bit worrying. Now they are expecting that to start moving back in the right direction in the next few years, but I wondered straight away, why are we seeing this profit drop down here? Because when I looked at this business originally, I saw this at 23 times earnings. Now at 23 times earnings with 10+% revenue growth, and if the profit was moving in the right direction, I thought this is an extraordinary opportunity. But there's a big massive profit drop off, so I wanted to dig in and see what is going on there. Now digging into the recent financials, you can see the revenue was still pretty decent, strong growth. Obviously would like it slightly better than what it is, but still not bad at all. You see the cost of revenue is 273,000, so this company is making major amounts of gross profit, as you can see here. That is really impressive. But when we dig into the recent financials, you can see here that research and development has basically doubled in the last 12 months, which is a major increase. And you can see here that sales and marketing as well has nearly doubled as well. And same again, when you look at the increase in sales and marketing, which is nearly 130,000, when you look at the revenue, that's not translated to revenue either. So it looks like the sales and marketing isn't being very efficient because the increase of 130,000 hasn't been reflected in the revenue. So that's a little bit of a worrying thing to see, that sales and marketing increase and also no reflection in that revenue. Also, when you look at general G&A, that is also up nearly 20,000. And you can see here the total operating expenses here has had a massive amounts of increasing. Now you can see here that there is also a few other things that have gone on in the business, as well as when you go further down, there's a stock compensation here, but you can see here the business is making quite a few investments at the moment and has dropped that profit down a huge amount. So even though it says at the moment it's 23 times earnings, it won't be that for much longer. And this amount of money that business is actually spending on itself, I don't mind businesses investing in themselves, but at the moment that isn't translating to revenue, and also is a massive downtrend on the profit side of it, which is a little bit worrying, and I was a bit disappointed from that point of view. Now it is worth saying this business has a fantastic balance sheet. There is no debt on there at all, and when you look at the cash balance, it's actually sitting on 5.7 billion in cash, and it's also a profitable business, so we don't have to worry about them burning through that cash, and in fact they'll add on to the cash that it currently has. So when you're a 29 billion market cap and 5 billion in cash, that is a really healthy balance sheet. So that is a 10 out of 10 balance sheet right there. When you look at the ownership side of it, it is also a founder-led company, which is great, and you also see that the founder, the CEO, owns a big stake of 10% in the business, which is also another really positive sign. Now, one key thing that I am going to finish on here is that you actually look at the metrics. Now, if you do look at the metrics from prior to the CV time, so the 31st of January, you see here the total enterprise value to revenue was 25 and now it's a 4. If we look at the total enterprise value to EBITDA, it was 153, it's now a 14. And if we look at the market cap to free cash flow, same again, it was 169 and it's currently down at 20. So you can see here from a metric point of view, this is actually really low. This is the cheapest that it's been since it's been on the stock market. And even prior to, if you wanted to go prior to pre-CV or during CV, this is a lot cheaper than what historically this stock has ever traded at, which is very interesting. And overall in the recent earnings, you can see here the company did grow at 7.8%, which was a slight miss, although it did beat on the EPS. Now it is probably dropping because it came out with third quarter guidance, which they do for 2023. That's their 2022 for us. They basically came out and said that they are expecting EPS to be a little bit worse than what was expected. They're also expecting the revenue to be slightly below what is expected as well, which is obviously why the stock is having the downtrend or the drop in pre-market. So for me, where would I potentially be buying this stock? Well, for me, first of all, the key thing is revenue. At 7%, this is a bit lower than what I would hope it to be, and the fact that they're also guiding that it's actually going to be dropping off more and more is a little bit worrying. I would like to see that stabilize around that double-digit growth, and also I need to know what growth it's going to stabilize at in the long term, because then I know how much I'm willing to pay up for it. If there's more growth, I'm willing to pay up a bigger valuation for it. If there's less growth, I'm going to pay a less valuation for it. So the key thing is watching where that revenue stabilizes in the long term, which I don't know yet, especially after the earnings, because there was a downgrade in that revenue guidance. The next thing is profit. Now, profit at the moment, obviously, like we showed, is taking a massive hit as they're reinvesting into the company. And at the moment, those reinvestments are not capitalizing into benefits for the business, which is really key. So I have to make sure that I value this off the correct amount of profit they're going to do. The difference is a year ago we were talking about a business that made over $1 billion in profit, and now we're going to talk about a business that's going to make 400 million profit. And I need to know where that profit's going to stabilize as well. I've got to say the balance sheet is absolutely amazing. No debt on there, major amounts of cash, which is absolutely amazing. It does make profit. So when would I buy? So considering this, I need to know the revenue growth so I can decide, am I willing to pay a bigger amount of valuation up? If it's 10+% revenue growth, I'm going to pay less for it. If it's 20% revenue growth, then I'm willing to pay more for it. The next thing is also looking where that profit stabilizes, because at the moment, say it's a 30 billion market cap, give or take where it opens up and it drops off. I've got to work out if this business is going to do 400 million going forward and build up from there, or if these investments are going to slow down and it goes back to more profit, and that's a key thing. So for me personally, if it's going to stay around this 400 million profit mark, if it stays around 400 million profit, I would actually only be willing to pay 12 billion market cap for this business, which would actually be even half from where it is right now. So for me, if it stays around where it is right now for revenue growth and profit, unfortunately the stock needs to half from here for me to be interested in this stock, in this business. At 21 billion market cap, if it starts ramping up then profit to around that 700 million profit range, that's actually be where I would be interested in it. So there's a few things that I have to watch here for this. If it can stabilize its revenue and gets back to 10% growth, depending on what it does with profit, I could be very much interested in this business right now. But at the moment, I'm kind of standoff, watch where the business stabilizes after the CV boom, and then I can assess it, and then I'm going to assess the market cap and see where it's at. But overall, I still think Zoom has a very good future because video conferencing is still going to be needed. It's probably going to be higher than what it was ever previously going to be because everyone's used to it, everyone's got it on their devices, and I think people are more willing to kind of go, rather than having that business meeting that means I've got to travel half an hour, let's just do it online. I save half an hour traveling there, half an hour back again. So I think video conferencing is going to be more and more mainstream, and I think Zoom are definitely the number one player for me to kind of think about owning. The only problem I have is I've got to see the revenue stabilize over the next kind of few quarters, see where the profit stabilizes, because if it is going to be around that 400 million, I can't pay 30 billion for this stock, which is something key. And from there, I can decide if I'm going to buy it. So right now, Zoom is just a watch for me. And like I said, I'll see where we're at in a few quarters time when we get a few more bits of information, how the business is doing after these tough comps from the CV situation, but I'll keep it on a watch list. So that's the video for today. Hope you enjoyed it, and I'll see you next video.